Hey everybody, welcome back to the Startup Sense podcast. This is your host, Jonah Lupton. Got a really exciting episode for you today. So look forward to speaking with our next guest. He is the solo founder of a company called LivePerson. They're actually a publicly traded company. So I think this is my first interview with the founder slash CEO of a publicly traded company. I've done a couple interviews with founders that have exited their company or they got acquired after going, public, but Rob is still running this company. He's been running it since 1995 when he started the company. They IPO'd in 2000. He raised approximately 40 million prior to that IPO. He owned 20% of the company at the IPO, still owns about 10% today. They have 1,100 employees in 12 or 13 offices around the world, and a nice split in revenues. So that means 50% of the revenues are coming from inside the US and then 50% of revenues from outside the US. So nice diversification there. Let's welcome Rob to the show. Rob, how are you, man?
Great. Thanks for having me, Jonah.
Absolutely, man. Thanks for joining us. So you've had a 22-year journey here with LivePerson. Maybe take us back to the beginning. Why did you start this company way back in the mid-90s?
When I started the company, when I started, the product line, and I really thought about there was a real problem at the time, which exists today, which is still the same strategy, which was there were only websites back then. But when I went to a website, I remember being on Dell's website and I wanted to buy a computer and I configured it and I had a question, I had to make a phone call and speak to someone on a phone call and hang up my internet connection at the time because it was, a dial-up. And I realized, why can't I ask a question digitally and on the website at the point of need? And that's how I invented chat. So in 1997, I actually invented chat for customer care. And when you see those little windows, that was a technology that I created. Today, it's about messaging and asynchronous messaging and mobile. So we shifted the company in the last couple of years, but I was just thinking the basic need, I don't want to pick up the phone. I just want to chat and ask a question right at the website. So usually entrepreneurs start their companies based on some problem that they saw or experienced. And I had the same thing.
So, the tools for building the software that you needed back then were probably nothing like they are today. How much harder was it back then to build those chat features?
I remember meeting with Sun Microsystems and they were showing us Java. And there was a group of us in New York that were doing technology on the internet, and we saw it for the first time. And it was really hard. You didn't have databases and the ability to connect to databases that came out. There was a lot of stuff. And more importantly, I was one of the first to create a hosted software platform that businesses, which today is cloud, but this is in 97. When I got funded in 99, I built my own physical infrastructure because there was the hosting, it would go down all the time. The internet would I remember the internet would go down all the time. So we had to provide a hosted service that we could guarantee service to our customers that wouldn't go down. We had to build our own physical hosting facilities. We brought in dark fiber. We had our own Catalyst switches from Cisco. We ran our own NOC. So it was so hard back then. We didn't have AWS. We didn't have the tool set that people have today. But we got through it. And that group of entrepreneurs were really the first to lay the foundation for the rest of the entrepreneurs who had built technologies around the internet.
Nowadays, we're all familiar with, the VCs and Silicon Valley and whatnot, but what did the investing landscape look for you for founders trying to raise capital back in the 90s?
I had my first company in actually 1990 that I started. It was in the interactive kiosk, touchscreen kiosks for college campuses. And there was no VCs back then. I raised money. I put money on my credit cards because that was the only way you could do it. And actually, I lost all my credit cards back in 95 when that company went under and I couldn't pay them. And I started then LivePerson and I rented a small office space in New York. My first company was in Baltimore. I slept on a couch. I didn't have enough money for an apartment and an office, and I wanted to maintain. I didn't want to quit, but there was no money. There wasn't a lot of VCs out there. That didn't really appear until in the late 90s. 99 is where I raised my first round of financing. But in the mid and early 90s, technology wasn't especially on the East Coast, there wasn't a lot to get from venture capitalists.
So 40 million back then, which I believe you said is what you guys raised prior to IPO. I mean, that's still a pretty nice chunk of money. But so
Yeah.
did you guys raise that from VCs, or what other types of investors gave you the 40 million?
Yeah, I mean, and I'll tell you like a lesson learned there. So I raised money starting in January of '99 after we created the chat platform. We had a couple customers, and I realized this could be big, and I need to raise some funds. And I had real VCs. So I had at the beginning a group called Dawn Treader, which was WIT Capital, and then I ended up with Highland Capital. Then I had KKR, Goldman Sachs. I had NBC and Dell, actually, Michael Dell, MSD Capital put money in, and I ended up having a really good group of investors that were there. In my first company, I did raise some money from friends and family and all this stuff, and I told myself I wouldn't do that again. And so when I started LivePerson, I said, there wasn't a lot of value in that. And if you get the right venture capitalists, and I really was very lucky, I had a great group of guys who funded me in '99, and they really helped me build the business and ultimately go public very quickly. So I think with the right investors, you can do well. I also tell every entrepreneur, get a great accountant and get a great lawyer. I remember even when I started LivePerson, I had no money. I went out and found a great lawyer and a great accountant in New York who I couldn't even afford. And I told them, I can't afford you right now, but I just want to sort of give you a little money. I gave them $500 each to put them on a retainer, because they ultimately, bad lawyers make bad contracts, and bad accountants do accounting that won't serve you. And so as an entrepreneur, you need to have a good basic team, which is accountants and lawyers and venture capitalists. And with quality people, and that in your gut, there were times I met people who wanted to give me money when I was raising money with the VCs. Some individuals would come out of the woodwork. I said no. And even though I know I needed the money, I just was disciplined, because I said, I only want people I think can help me grow fast. And it's a good filter to put in on the VC side.
Now, when you guys, so 2000 was sort of I don't know if that's the beginning. I guess it was at the beginning of the bubble. I suppose it probably was.
It was the end. I mean, April 7th is when we went public. That was the end. So you had you had a ramp up in '99. You had it started to peak towards. We saw it at about August, September of 2000, and then 2001 was starting in January 2001. It was just a straight line down. So that was kind of how it built up. And the bubble got created because half of our customers were .com. So bubbles get created because you're selling to yourself. And so when the .coms all of a sudden the money stopped, nobody's, half of our customer base couldn't pay our bills. And it was that's the bubble. You saw it in the housing crisis. It's an incestuous world that building and housing and financing of the housing, and it's all so interconnected, but it's in its own little world. And if one piece gets pulled out, the whole thing collapsed. And that's what we saw in 2000 to 2001.
Right. There's a whole domino effect that happened.
Right.
I remember I had a couple buddies that worked at furniture companies that sold mostly to tech companies back then, and they all went out of business as well.
Yeah, I mean, there was real estate, tech. I mean, we had all these supporting services keeping us alive. So, we went public on April 7th, and that week, I think 20 companies were pricing to go public, and only 4 of us actually went public. Krispy Kreme Donuts, funny enough, which was not a technology company, obviously, went public when we went public. So we had a very tough IPO. We had to cut the amount of money we were raising in half. There wasn't a huge celebration when we went public. I opened NASDAQ. It's it was all red behind me. It was just, we need to get out. And then we had to now focus on the new reality, which was, survival. And that's what we went into.
So how close were you guys to going out of business at the end of the bear market, in 2001, 2002, 2003, as a lot of your customers were going out of business?
Well, we entered 2001 with about 20 million in cash, and we were losing $2 million a month. So the simple math is we had 10 months of cash. As a public company, you don't have much opportunity to go down to zero. They don't really allow that. So when I was looking at the numbers, plus we had some leases and stuff, we had free cash, probably about 15 million. And so we had 7 months of room here to go to zero. So we, in 2001, presented the board with a restructuring plan. And that restructuring plan, we had 180 employees, and we put a plan in to fire 140. So we'd go from 180 down to 40, which this is another thing, like you'll hear this a lot of times there's 2 lessons here. I've got 3 lessons on this one, but one is there's a concept like how far could you cut before you can't run the company? And there's this concept of cutting to the bone, like you're going to cut into the bone. And you would think going from 180 to 40, you would definitely cut the bone. And it turned out it was fine. The 40 people that remained hunkered down and focused and took a greater amount of responsibility. The other part is when you're losing $2 million a month, this was another lesson for me was if you lose $2 a month, so I'll go back to $2, not 2 million. There was a point where we were losing no money. So when we were private from 95 to 99, we actually made a little money. We did consulting projects and built websites, and I had to pay people, and we were making a little money. When we got funded, we started a fund and lose money. It was the nature of what we were doing. The challenge with that is that it's discipline, which is if you start to lose $1, I remember being in marketing meetings and be like, well, we're already losing, $10,000, so why not lose 15,000? And the discipline of everyone is it's okay to just spend. So if you have no floor on spending, you can get into a place where you're spending $2 million a month, you're losing $2 million a month. So after we made it through survival, one of the things I just, as a discipline, said I would never want to burn money because the team becomes undisciplined, and that's dangerous. And that's a danger of these heavily funded venture capital companies. If you're losing 10 million a month or 20 million a month because you raised $1 billion, it's really hard to unwind that. So that was really something that I think is a lesson learned for me.
So talk to us about how has the company been growing over the last 5-10 years as you've done a makeover on your products and services to be more current with what the market demands these days.
So just to go before that time, up until a little over a year ago, maybe 2 years now, I had 56 quarters of growth, straight out 56 quarters. So I always admired Cal Ripken, and I thought, it's like this Cal Ripken mentality to business, like just go to work every day, put in your hours, like really kick the shit out of it and deliver growth. However, with that said, strategically, about 4 years ago, I wanted to really expand what we were doing into what I think is one of the biggest markets in front of us, which is this idea of conversational commerce or messaging. And so I felt, at that time, I could see that consumers were using our devices to message our friends and family on WhatsApp and Facebook. I said, I could see this happening with businesses. I think this is going to be much bigger than even what we're doing with chat. And so I went into a period of investment with the company. And then last year, we migrated all of our customers onto this new platform we built over the last 3 or 4 years. And so we did not grow last year because we were very focused on just migrating. But it's the right thing strategically to do because now I've got a beautiful new platform. I've got a platform that aligns with, I think, the next 10 years of a very high growth potential. And I've got now all my customers on that platform. I've got thousands of customers on it. So it was painful, and we did a migration, and I'm not sure I would ever do it again as a company. But it's the most death-defying thing. And one part of that is that you don't want the employees to get into a place of thinking like that we don't grow, that we're a no-growth company. And you can start to feel that, as you're migrating. You have attrition goes up, you don't grow. It's all the ugly things you could expect. we're on the other side of that now, but it was like a lesson learned. And now we're back into growth thinking, expansion with our customers, not maintaining them. But that was the only time we didn't really grow. Up to that point, we were growing about 20% a year. So we were nailing 20% a year after year.
Can you give us an example of a couple of your customers that are now on this new platform and how they're using it?
Yeah, so we've got a bunch of customers on it, but we've got like T-Mobile, one of the large telcos in the U.S. They were our first customer to go live, and they last year, and in their app now, in their care app, you can message their care reps. And so imagine you can message and go about your day like, hey, my bill looks wrong, can you check it out? Instead of being on hold and dialing in, standing on a phone for an hour or 6 minutes, whatever it'll be, you can message in and go about your day. So customers love it. And it's really powerful. There's an ongoing connection with that consumer, with the brand, and the consumers are very, very high customer satisfaction with this way of communicating. So we've done some very good work with them. We're on a couple million devices right now. I can't give the exact numbers, but we're on millions of devices, and it's a lot of agents and a lot of consumers. It's at scale, and we've got many customers like this right now that are doing this, and we've had some great impact. My goal is to get rid of voice. I believe that our world would be a much better place if we didn't have to dial in, be put on hold, and waste our time. And
Right.
Time is the thing in the digital world that we consider very precious.
Right,
In the general world.
Nothing more frustrating than calling customer service, waiting on hold for 20 minutes. You finally get someone, and then they have to pull up your account and they have to look through it, versus you messaging them. And then when they call you or message you back, they already have your account. They've looked at it. They know what the problem is, and they can get right to it.
That's it. And so that's the power of it. And so the funny thing is, like, if you take a large bank, let's take a large bank, they could be spending between $1 and $1.5 billion a year taking phone calls. God. And even though you probably think they have nobody there, like nobody answering the phone, they could have 20, 30, 40,000 people ready to answer your call. But because of the nature of the technology, it's technology, it's 100-year-old, crappy, old analog technology. It doesn't have a place in the digital world. And whether you're old and you're 80 years old or 70 or 50 like me, or you're like a millennial, nobody wants to call. People want a message. So it's not a millennial thing. It's that we see, like, it doesn't matter. Just people don't want to call. So it's going to be what I think is one of the biggest transformations, because there's 268 billion phone calls that take place every year to these contact centers. And it's just like, it's so much time is sucked out of the world on hold. So this is the thing we're solving, and the agents are happy who message, and the consumers are happy. It's creating a great work environment.
So does your technology seamlessly plug into their website or their existing mobile app?
Yeah, so we've got APIs that plugs right in the website, mobile app. We have a partnership with Apple in which we're in iMessage. That was just announced. We have Facebook, so you can come through Facebook, SMS. So you can come through any one of the front-end messaging platforms today. We have Line in Asia, WeChat. So you can come through any of the front ends. You can also just have it in your app or on your website.
Have you guys gotten into this whole chatbot thing?
Yeah, so when you really boil that down, it's about automation. So how many of these conversations can be automated with what we call a bot? This, in the customer care world, is called a virtual agent, and there's been a tremendous amount of failure in this virtual agent space up until today. We are doing really good things with like IBM and other bot makers, empowering these on our platform. And why that's important is that when you plug a bot into it's called LiveEngage, our platform, we manage it like an agent. So you can actually see the bot working in real time. And the way our customers are deploying is that they'll have a human agent managing a bot or a series of bots. And if the bot starts to fail, the agent steps in, and just starts interacting and helping the consumer, creates a good experience. And then the agent goes back into the artificial intelligence, let's say my IBM Watson, they create the information of that conversation, and now the next time a consumer comes in, they're going to get a good experience. A lot of bots, there's so many out there, are really bad because they're deployed wrong. They're not real AI, and they're not really being managed. And so we give away for these bot makers. So we're working with, I consider the best in the world, and we're deploying them at scale, and that's the important thing.
Now, over the last 15, 16 years, it looks like LivePerson has made a handful of acquisitions, maybe 9 or 10 of them.
Yes. Yep. Yep.
When you guys go to make an acquisition, what are you thinking about? Is it a product that you want to add to your portfolio? Is it the team that you're really acquiring? I mean, what's the strategy, I guess, with these acquisitions?
Look, it's always you're always looking for really talented people, so it's always team first or the entrepreneur. I still have a good number of those entrepreneurs that we acquired here at the company today. So because I'm an entrepreneur myself, I value that DNA in the company. But we've done a lot of technology acquisitions, small companies, and for the technology and some really good people. We did a vertical play in messaging around automotives called Contact at Once about a little over 3 years ago. And that's been a great acquisition out of Atlanta. So we've done a different type of acquisitions throughout the years, but the focus is really to have a really good set of people working here and to make the integration into the company positive. These are people from another company that had a culture from that company, and we very much focus on how do we integrate the cultures and the connective tissue between the companies so we feel like one company, even if they're doing something that's a little different.
Now, how do you manage 12 offices? What is your, I mean, that can't be easy. I'm sure you have managers at each different office that probably check in with you, or what is your hierarchy there? I mean, how do you make sure that each office is being as productive and efficient as possible?
Well, most of the offices, obviously there's a reporting structure. An office is not sitting out there unless it's reporting into somewhere that obviously will get to report into me somewhere. But hierarchical reporting structures have one function, and the other part is culture. So if you have a set of values, and we did a lot of work on this in 2010, we have 2 core values: be an owner and help others. We're actually going through an evaluation of these values right now because we're a new type of company. As of January, I feel like a new company. I feel like LivePerson is not the LivePerson of the previous 22 years. And so we're rethinking how to define those values, be an owner and help others. So if those values are instilled across the world, the way people make decisions should be in line with the company's goals and how we operate, how we communicate. And that's what you need. After I got past about 300 employees, we no longer could depend on just centralized systems, like a very top-down type of way to communicate and run the business, because you have people around the world. So we had to build a cultural framework, and it really is a framework in which people operate. It's an ongoing thing. It's not static. It's just this dynamic, ongoing thing that some days I scratch my head about. Other days I feel proud of it. Culture is a commitment of a lifetime, and it's an ongoing process. So that, combined with our traditional leadership, is how you manage a global operation.
So for anyone listening to this podcast that may be starting a company, maybe running a company, certainly not a public company, but maybe that is one of their goals, what can you tell us about what it's like running a public company, and what's the biggest adjustment, or what's the hardest thing about going from running a private company to running a public company?
Well, first of all, since I was 15 years old, I've always wanted to run a public company. So I read a book on it in the library. I still have that book, actually. And actually, I opened NASDAQ for the second time a couple of months ago, and I gave a speech that if you go to you can find it on the NASDAQ website, I think, and I think it was a good speech about this, which was, first of all, I consider it a privilege. Being a public company, and there's only about 5,000 of us in the world, or in the U.S. markets, and in the U.S. market, it's like Olympics. You know, you're playing at the highest level. There's a lot of criticism of it, the quarterly calls, the investors, the analysts. We all have owners. Unless you're private and you own 100% of your equity, someone owns something in your business, and you'll have to be accountable. And running a public company, I think, is the highest form of accountability. Why? Because every quarter, and I'll be doing this next week, I will report the fact of what's going on, and numbers are the facts. And then I give it color with analysis of how those facts played out. If I'm a private company, I can make up a whole other world. I can be here like, everything's great, we're doing awesome, everything's great. And you don't have to, you know, that's awesome, and the company could be going under. Even during this very difficult transition where every quarter reporting like customers leaving and stuff happening, it's out there. And we as employees, as the entire employee base and employees' families and their friends, they see it. And you got to deal with it. And so you really don't want to waste too much time on change and things, because there's a pressure of that quarter. And I still think it's where high performance is. Like, if you want to be in a high performance game, stick yourself out there as public. Like, and you'll be accountable in a much different way. I don't want to make any political statements, because I think business has a greater reach in changing the world and impacting the world. But before our president went public, you know, obviously he supposedly runs a really big company. And as I explained to one of my family members who was voting for him, I said, and I don't know him, and I don't have any judgment towards how he's running our country. Leave that for other people. But my only thing was this: he never ran a public company. And my aunt, who was really excited about him, she said, he ran a $3 billion company, it's global, and this. And I said, he runs a family business, and his kids report to him. And that's very different than running a public company and being accountable to public shareholders. And these are two different worlds. No matter how the size is, when you're a public company CEO, you're accountable to shareholders and to a truth that you have to keep to. And so I think there was a confusion of just size here, and maybe some of the things we see. And once again, I'm not making a criticism, is that you can get away with it if you're like private. I'm making comments and being on Twitter. Like, I can't be on Twitter making comments all day.
Right.
Like, the shareholders would be like, you're nuts. My legal team would be like, this is crazy. So I have to be very careful. And there's one test I was told many years ago from a gentleman who was vice chairman of Seagram's and Morgan Stanley. He was on my board. He's on Disney's board now. He's Bob Matchell. I said, you know, there's this thing called the Wall Street Journal test, and there's times in business that things are gray, and you can go either way with it. And it's not like what you're doing is illegal or not. It has nothing to do with that. It has to do with, these are gray areas on what things can be perceived.
Right.
He said, when you make decisions, make sure that you're thinking about that, because if someone wrote an article about that, how would it be perceived? Even if it's all legal, how would the perception be? So there's a higher standard of this test. I call it the Wall Street Journal test, that of the decisions I make, I have to make for something greater than myself, because we have to every quarter talk about that. And that's one thing. To get here 22 years later, I think I've always, for better or for worse, just thought about what is that standard above that I serve, because I'm serving a greater group than myself. And I think as an entrepreneur, you always have to be a servant to that greater group, which are your customers and your shareholders. And if you think like that, then you're going to run a company at least has a high quality standard, which allows you to be around for 22 years.
Now, nowadays, how does LivePerson acquire their customers? I mean, I'm sure there's many different ways, you know, between marketing and conferences and salespeople and everything else. But is there one method that's really driving the most growth? I mean, because there's other companies out there that have probably similar products and services to you guys. So I'm sure you have competitors. So how, you know, when you do land a big client, how are you guys doing it?
Well, today we don't, you know, this is one of the things, like we invented this technology, and this is the other thing, like we invented something that has not existed before we invented. Like when we took T-Mobile live, they were the first customer ever to go live at scale with messaging, and we've taken more. So one thing I was gonna say, today we do have this lead. Yeah, there's startups now and there's stuff happening. So this is correct. There'll always be competitors, but it's important to be, I think, a premium product and service, and we're a platform. So I think from a positioning standpoint, if you position premium in the market, then you have knowledge. And the way we've gotten here is that we've always maintained premium product and premium knowledge that we're sharing with our customers. So today, the best way we're increasing the value and getting more customers is that we have customers that are vouching for what we've done with them. And when you're doing innovation work, and we have a lot of early adopters, which is very exciting when you get that early adopter who's excited and they can't wait to get on a call and speak to someone. This is the thing right now that's helping us the most, because we do marketing, we do trade shows. I mean, we have great marketing events, but we're utilizing our knowledge with what the knowledge is of our customers to create a community, because everyone who's doing this right now is new and we struggle with a lot of it, and we're winning some days and not winning, but we're all trying to work together. Even competitive companies I've seen work together now to just figure this out, because they're just proud they're doing something new when it comes to customer care.
So go back to 95, 96, after you started this company, raised a little bit of money, started hiring. Who are the most important people that you hired back then that really helped you build this company?
You know, I hired, when I got funded, I hired a very great head of sales. There's a trap in that for a lot of entrepreneurs. Sometimes I mentor entrepreneurs in my free time when I can. And a lot of times, like, they'll want to hire a great head of sales, and they'll find this person who came out of some big software company. And I'm like, why do they want to work for you if they've run like 100 people? And there's always a way to sort of rationalize that, but there's also a trap. I see a lot of failures there. You have to get the right sales leader. A lot of times, someone who ran a big organization, they can't handle being more entrepreneurial and doing more things themselves. So you have to really check if they have that skill. The other thing is, usually they get paid a lot of money. Like, I can pay my people a fair amount of money, more than a person in a startup, and there's still a lot of value here at LivePerson. I mean, our stock's been up 60% in the last couple of months, and we're at the beginning of this next transformation. So I'm competing with a startup, but I maybe can give more certainty to someone like that, plus more resources. So you got to ask yourself, can that head of sales, can they handle that? We have limited resources. I can pay them a certain amount of money. I need them to be committed. So my first head of sales, I found a guy who came out of more of an entrepreneurial background. He had run, you know, large enough, like 50-person teams. He had just taken a company public a couple of years, so he had what I wanted, high energy. So I think a great head of sales can be great, and a great head of technology. You know, we've always had really strong technology leaders here all the way through. And I think if you have those two, hopefully you come with one. I mean, as an entrepreneur, usually you come with one, and if you don't, then learn one. I mean, I didn't go to school for coding, but I learned how to code because I had to build my first products. So you just got to kind of learn everything. But head of sales is pretty key, and a head of obviously your technology heads if you're in technology.
Over the past 22 years, what's the best decision you ever made with regards to the business?
The best decision I've ever made. There's a lot of those decisions. I think the best decision I've made, which will play out in the next, I think, three years or so, is the decision 4 years ago to commit to building a whole new platform.
Right.
And doing this. I think that'll turn out to be the best one. The other decision, now I'm giving you different times. The first, if I go back to my whole entrepreneurial career, one of the big ones was I didn't take money from someone when I was raising money who was an individual, and I waited to get a venture capitalist. The second one was when I realized that the internet was imploding. I didn't wait to fire to to fire the appropriate amount of people and restructure the company so that I could survive. So I didn't try to kid myself that something was going to happen. The next one was in 2006, we thought up a whole new product line, and I had a sales team that didn't really jive with how to sell the new way we created this thing called proactive chat, and I gutted the sales team. I literally gutted everyone in that sales team and hired a whole new sales leader. And I, you know, it was a bold move, but it proved really successful. This one was, I felt that chat was only going to get us so far, and we needed to pivot into something far greater. So I think each time there's one of those in-your-face moments, and either you just ignore it and think it's just going to work itself out, or you go bold and you just go, that's it, I'm going to let the whole sales team. I remember a quarterly call in that 2006 timeframe where I had to tell everyone we have no more salespeople. We had one. I think we fired about 10 of them. We only had 10-person sales. It was like, we got rid of the head of sales. We got rid of all 10 salespeople. We have one left. It was like the shareholders thought we were crazy, but it was what was necessary to like open up space and build a new sales team. And that got us here.
So last question, I know you're a busy guy, but I've been dying to ask this, is how do you feel about this new trend of companies staying private longer, raising tons and tons more VC money, you know, before they actually get to an IPO, which may not be for 8, 10, 12 years after they're started?
I think, you know, I think it's not great for shareholders. And unfortunately, after Sarbanes-Oxley, so after 2000, with the whole, all the things that happened with the CEOs from Enron specifically, and there were many others, there was a reaction by our government to create the Sarbanes-Oxley Act, which basically imposed a lot of stringent standards of running a public company. And that actually, if you go back from that point, you're going to see a massive decrease in companies going public. And so I can understand that nobody likes all the restrictions and regulations and the things we have to do with auditing today, although I think a lot of it is really great. It's been really great for companies. I think as a private company, you've got to get your shareholders whole. That's the goal. And that was always my goal, to get public and get my private shareholders whole. The one thing I'll say is that public company shareholders can be very smart people. They're really great, and they're as great as any venture capitalist or any private equity person. You're great shareholders. Like, they can be smart technologists. I've met an extraordinary group of shareholders over 16 years. Some guys have come in and out of my shares, and that's the key. When they leave, they just sell and they go, and it can happen in a day. And that's actually, it's quite good, because in many ways, unlike venture capitalists, where a lot of times I see they just lose patience very quickly and they just like remove the CEO, or they put a lot of pressure on the person. Where in public company land, the flip side is most of the public shareholders, there are ones that are hostile, and we know that, and they have their place. They definitely are, they should be there. But most of them are just like, I don't want to be in the stock anymore. They trade out and they go to something else. You don't have a board. They're not on your board. They're not creating that animosity. They just are disappointed, and they understand it. They trade it, and they're very analytical about the trade. I have guys that traded out of my stock 1 year, and 3 years later they came back in and we're still friends. There's no hard feelings with it. And I think in the private company world, there's a lot of hard feelings and a lot of emotions. And a public company board is very strategic about thinking. Usually they do have some stock options and things. Sometimes they could be shareholders, but they're taking a broader perspective, because they usually don't have the large slugs of equity and they're on your board. And so I think as a private company, you have a better chance at having some freedom if you go public, and you have the capital markets to raise money and do things. So I would recommend it. I just think it's a disservice to shareholders not to get them public and get them whole. And that's why they invested in you. So that would be that's my advice. And I hope it becomes easier maybe to go public. When I went public with like 2 million in revenues. That just doesn't exist anymore.
Wow,
So,
really? 2 million?
yeah,
Holy smokes. Yeah, you
but
definitely.
that was nothing. I mean, I remember there was a company, I forgot the name of them, I'll get it. It was, I think it was Webvan, went public with like 0 revenues on like a multi-billion-dollar revenue. Yeah, so they just needed to raise money to build warehouses because they were doing groceries,
Right, right.
online. But I think, there is a very high bar to get public, which is great. Maybe they want to lower the bar back down, but it created a lot of issues like we saw in the .com. So, but I would recommend it. If you're running a company and you want to go to the Olympics, then go to the Olympics and play and see what it feels like.
Yeah, I mean, I hope the bar does come back down because I spent 9 years in the investment world, and I do miss the days where companies were going public with, $200 million valuations, where you felt like as a public shareholder, you still had some upside left. Revenues were growing at 100, 200% a year. Now you see companies going public at $20 billion valuations. Growth has already slowed, and you wonder how much more upside is left for the public shareholder. So.
You're right, and that was the cool thing. I mean, if you look at Microsoft, take like the greats. I look at the tech greats like Microsoft and Oracle. I'm talking about you got Intel. Those first guys who went public, they probably raised like $10 million.
Yep.
And they were like, I love reading the stories. They went public. They were like 500-person companies, had great growth. You had these great investment banks like H&Q, Hambrick and Quist took us public. They were like one of the greatest tech banks. They're not around anymore, but they were one of the greatest. And they took like all these great technology companies. It was such a pride on it. And you were small, and the individual shareholder could get in. Maybe they used a Microsoft product, like, I can buy that share for $2 a share or $5, whatever. And you're right. It just creates this excitement to America. And, the bigger picture here is my family came over as entrepreneurs from Italy back in the early 1900s and started small companies. And I look at my progression as an entrepreneur. I come from an entrepreneurial family. And I look at the progression, but that's America. Like, seeing companies go public and all that is all about us and our creativity and the wealth created from creativity. And you're right. It's for almost like a very high class. Like if you're good enough to get into Uber somewhere, you got to get on a venture capital fund and be a registered, then you're lucky to get there one day. But most Americans can't get their hands on a little Uber share, even though they're riding in Uber cars. And that's the beauty of the American dream. It's like you get a little piece of the dream when you're able to buy a share of stock, and there's a pride in that. So I agree. I think it would make our country just have that feeling of the cool, innovative thing that we are, but you kind of make it a way for other Americans and other people in the world now, obviously, to get their hands on a little piece of the share.
Right.
And
absolutely.
like when it's $20 billion, you're getting your hands on something it's a risk. It's actually a much greater risk.
Right.
And not as exciting.
I'm a risky guy. I have no interest in buying IBM stock or Nike stock. Their growth days are over. I mean, they're still fabulous companies, and I'm sure they're still growing slowly. But I want the big upside. So, well, thank you so much, Rob. Really appreciate your time today. This was a true pleasure. Anything that we can do to connect with you online? Like, do you do any blogging or use any social media?
Yeah, I'm on everything. I'm on Twitter, Facebook, Instagram. I'm kind of, and then if anybody wants to email me, they can email me at rob@liveperson.com. Entrepreneurs email me all the time, and I'll answer questions. And I meet with people. I feel that I had people help me and mentor me and give me advice. I'm actually investing right now in Brownsville, Brooklyn, which is a very hard-hit area of the 5 boroughs of New York. And I invested in entrepreneurs there. I've got a cafe. I funded 3 sisters who were working out of their house baking cakes and stuff, and now they have a cafe there. And I funded it, and I'm out mentoring them, and we're mentoring entrepreneurs out in Brooklyn. And I find it very satisfying. So if anyone here has a question, they have any concerns, I'm here, because I think the entrepreneur journey can be a very lonely journey. And there are days that we think, oh my God, this can't be happening. And I can't believe anyone would ever experience anything as bad as what I'm experiencing. It could be the loss of a customer, an employee quits. your sales guy runs off. I can tell you everything I've seen in my life. It's just nice to know that there's other entrepreneurs that have experienced the same thing. You'll make it. Don't freak out. But if I can be here just to give you a little bit of a boost, I've seen a lot over 22 years, I can tell you that. So just email me at rob@LivePerson.
Very cool. I appreciate that. Very kind of you. Thank you so much, Rob. Have a great day and look forward to staying in touch with you, man.
Same here, Jonah. Have a good one.
Okay.
Thank you.
See you.